Today we explore the supply side factors relating to silver to determine the potential upside possibility for the white metal. This video is the first in a little mini series examining silver and its market fundamentals, so let's dive on in. Now, this channel offers global macro insights and preaches the virtues of sound money and sound economics, so do consider subscribing. So silver's real price performance over the last 40 years has been dire. It's really disappointed. Just look at the inflation adjusted price of silver in this chart. The dizzy heights attained in 1980 have not been seen since. This video will use research from the excellent In Gold We Trust report as well as from the Silver Institute. You'll find links in the description, so do check out the In Gold We Trust report. Silver remains one of humanity's most important metals due to its widespread use in industry. And Ronald Stoffel and Mark Valek assert that the fundamental and financial outlook for silver with respect to supply, demand and price might be better than for gold. We'll be surprised if the decade or two ahead are not some of the best years in silver's long history. This is very compelling, so let's start by exploring silver's supply constraints. First, the report establishes that mine supply is price inelastic. Now, this simply means that if there's a 10% price increase in the cost of buying silver, you may only see supply increase by 2% or so. They believe that, roughly speaking, 3 out of 4 silver producers will not automatically seek to produce more silver if the price rises. Secondly, as we pointed out in this video, that the bear market for miners between 2012 and 2018 or so means that capital expenditure has been reducing considerably throughout this period. While this means that mines have the capacity to actually expand, this won't happen automatically, particularly if lending availability is at all restricted with any potential credit crunch. Now, this further will enhance the inelasticity of supply, so the ability of miners to actually increase the supply of silver in the future. Third, industrial scrap and recycled photographic film combined account for 12% of supply and are capped by a depressed economy. That is that the collapse in industrial output that has not just taken place in recent months, but has been experienced over the last 12 years, during which time we've experienced below trend growth. So what about the supply side factor of recycled jewellery and coins? Well, this market is supply elastic or price sensitive, so thus a 10% rise in the price of silver may give rise to a 15% increase in the actual supply of metal that becomes available on the market. Yet, as Mark and Ronald point out, there is the intriguing possibility that one source of previous supply could actually flip and become a source of demand for silver. Of course, that source is the government via the central bank. They believe that through the next decade that there is the possibility that governments will add silver to their reserves, as we have witnessed in gold in recent times. If we consider previous government trends here, governments sold around 67 million ounces of silver a year between 2000 and 2004, while in the following 2 years they sold around 77 million ounces of silver. Yet government sales of silver fell to an average of 29 million ounces per year between 2007 and 2011. Since then, governments have sold just 12 million ounces in total, and effectively nothing over the course of the last 5 years. Now remember, we've previously seen how central banks switched from being net sellers of gold to become net buyers of gold. Will we see the full reversal back towards silver? Well, the trend we see here certainly seems very, very interesting. The authors believe that countries such as China, India, Mexico, US, Russia and Poland are the most likely candidates to actually start adding silver reserves. This is due to the large silver deposits within their countries and the historic use of these monetary metals. Now, while this is not the preferred approach of central banks, the authors note that history does not speak kindly of central bank independence, which has seen a number of key trends take place and a significant reputational loss towards these banks. Now, this has included a trend towards greater populism and nationalism, the reputational loss of central bankers and their failure to achieve their self-chosen metric for success, which is of course CPI inflation growth. That is the consumer price inflation growing at 2% per year. Meanwhile, enormous market distortions through financialization have seen near impossible things occur, such as flash crashes, negative nominal interest rates and negative oil. At the same time, we've got Dave Portnoy really championing and making this whole situation look so ridiculous of the Fed's recent intervention. Yet amidst this backdrop of distortion, silver remains absurdly cheap and has been a holding of central authorities for more than 250 generations. And so our understanding of silver's supply side factors means that in the face of real economic hardship, we can expect an increase in coins, silverware and jewellery to return back onto the marketplace. Between 2008 and 2012, for example, it amounted to about 78 million ounces per year. This is around 8% of total supply. For the years 2003 to 2007, the average was just 28 million ounces per year. So the authors anticipate that silver will face an additional 30 to 40 million ounces for each year of real economic hardship. Photographic film is no longer a source of supply and had previously contributed around 5% per annum. Meanwhile, industrial scrap silver is price inelastic and represents around 9% of total silver supply. The collapse in industrial output, together with 12 years of below trend growth, means that there is very little upside potential for silver supply from scrap. And so what about paper silver? Well, silver is actually the 13th largest commodity by market value, but it supports the 5th largest financial web of derivatives or paper contracts. This puts silver's financial to fundamental ratio at over 140, which is the largest derivatives ratio in the commodity markets, and this bears significant impact upon the silver price, of course. Now, the following table from the Silver Institute provides us with a numerical breakdown of silver over the course of the last 10 years in terms of millions of ounces. The total output has remained enormously constant throughout this period. Even 2011 fails to act as a potential outlier, despite silver attaining an all-time high in the latter half of that year. Thereafter, there was little to no change in silver supply, even in the face of greatly depressed prices. Ultimately, silver certainly faces considerable supply constraints, which supports the potential for vastly higher prices in the future. Here's a summary for this video, so do pause, check it out if you wish to go through this. The next video in this mini-series will examine the demand side factors with respect to silver, so do make sure you've hit that subscribe button, hit the like button, hit me up in the comments and let me know what you think of silver's potential in the coming decade. In the meantime, make sure you check out these videos and I look forward to seeing you next time. Bye bye.